Good morning and welcome to the 2024 China Investor Symposium, When or If to Invest in China. Thank you all for joining us today. My name is Hannah from VanEck, and I'm pleased to be hosting today's event. VanEck's China Investor Symposium is now in its fourth year and has proven to be one of our most popular events. Traders and strategists globally have been and are closely watching the world's second largest economy. As China's markets resume this week following the Lunar New Year break, there are encouraging signs that consumer sentiment is strengthening, particularly we saw in retail sales and travel, and we saw the central bank on the move with a sizable cut in their benchmark for mortgages, the 5-year loan prime rate. There is a lot to talk about in China, and that's a reason why we hold this event, because we want to help the investment community access informed analysis of China, its economy, and the trends taking shape. To achieve this today, we are joined by 3 experts who will explore the latest data and share their analysis with us on China and the investment opportunity it presents. We will have time following our 3 speakers' presentations, so please, as you think of them, please place any questions you have for our panel in the Q&A function within Zoom, and do let me know if you'd like to direct your question to a particular person. That would be great as well. Before we begin, a reminder that what is presented today is general in nature and is not personal advice. There is some further information at the end of the presentation to have a read of. Let's begin with our first presenter, Natalia. Natalia has spent many years as a macroeconomist and market strategist. Her area of particular expertise lies in emerging markets, fixed income, and credit analysis. Before joining VanEck around 10 years ago, Natalia's experience spanned across a global macro hedge fund, top-tier investment banks, and a leading macro consultancy. Natalia holds a PhD in economic history from the University of Oxford and a BA in economics from Moscow State University. I'm pleased to welcome Natalia. Hi, Natalia.
Thank you, Hannah. Well, a huge country, a major global economy, and very limited time that we have today, unfortunately. So my suggestion is to kick off our webinar by going through several macro and policy issues.
Thanks, Natalia. So Natalia's going to set the scene for us, providing a macroeconomic update and talk to us about what matters now in China. So Natalia, I'll leave it to you to take us on that journey.
Yes. Thank you. So as I said, I want to kick off our webinar by going through several macro and policy issues that I think matter the most for China right now. And these issues are, first of all, China's growth must slow. Point number 2 is there are no quick fixes, even though the market likes them. Point number 3 is fiscal room is not unlimited. Point number 4 is property debt resolution will determine the effectiveness of additional stimulus. Point number 5 is effects considerations will dictate the pace of monetary easing. And the final point is geopolitical tensions in China. US strategic competition will get more intense. Whenever I talk about China, whenever I make presentations, webinars, I always like to start with a slide which shows basically China's slowdown in perspective. There are multiple reasons why China growth should slow down in the coming years, and reason number 1 is very simple, actually. China is getting richer. Our measurement of being rich is per capita income on this chart. And richer and more developed countries tend to grow at a slower pace. I can show you the same chart in a slightly different format with country names in it. You can clearly see that what China is doing is moving in the footsteps of its predecessors, Japan, South Korea, Malaysia. I also decided to add India to this chart because there is a lot of comparison between the 2 economies right now, starting from India's equity market outperformance and ending with India's superior growth stats. However, as you can see, India is still much poorer. Its per capita GDP is still less than $10,000, and this puts it in a completely different per capita income growth basket. At this stage of its development, India should be growing at 7% a year in real terms, if not more. And by contrast, if China starts posting such growth rates, this will be a sign of a policy mistake. So China's problem is not growth slowdown per se. China's problems lies elsewhere, and this I want to show you on the next slide. The chart on the left shows that China's growth not only slowed, it became extremely volatile after trending down in a very controlled way as China's GDP per capita was gradually increasing. Some reasons were very traumatic but transitory and already behind us. I'm talking about the pandemic-related disruptions and lockdowns. Some factors like tariffs became less pronounced during the Biden presidency, but might stage a comeback if President Trump is reelected. But some factors might have a much longer shelf life. China's old growth model is getting exhausted, especially such drivers as real estate and leverage. A good thing is that authorities are well aware that they have a big problem on their hands. The problem is that earlier attempts to deal with these bubbles were too harsh, too rushed, and they backfired as a result. Um, Importantly, it doesn't look like there is a comprehensive longer-term plan in place, which means more uncertainty going forward. And the current status quo in terms of growth impact is shown on the right chart. As you can see, the share of real estate and construction in nominal GDP dropped significantly in the past 3 years, and replacing it is not a straightforward task. One popular suggestion, which I try to present on the next slide, especially among Western economists and investors, is that China's growth model should evolve towards a greater share of consumption. Well, indeed, the chart on the right shows that the share of consumption in China's GDP is lower than in its regional EM peers, and especially than in advanced economies. However, I see several headwinds here. A more fundamental problem is that the increasingly anti-consumerist shift in the official ideology is hardly compatible with the redistribution of income from the state-owned enterprises towards households. A more practical problem is that fixing China's consumption without fixing the housing sector is probably mission impossible. You can see it on the left chart. Housing still accounts for the largest share of household balance sheets, and it is hard to see people spending or reducing their precautionary savings until there is more certainty about the housing outlook. Now, you can see on the next slide that the Chinese economy is not a monolith. Some parts of the economy, the so-called new industries, are actually doing pretty well. You can see it on the left chart. These sectors now account for about 11% of GDP and are already important growth engines. However, various estimates suggest that the final demand multipliers are probably lower than in housing. This is the chart on the right. And this tells us that it might be some time before they can fully compensate for the falling share of real estate and construction. There are also some very sane proposals regarding the development of the social safety net, which China desperately needs, as well as some interesting initiatives in real estate, including the urban village and the Singapore housing model. Both can improve social cohesion, free savings, and boost growth on a more sustainable basis. But this is a longer-term game. So there is no quick fix in this regard. And as a result, the near-term growth outlook is still less certain, which is why there is so much emphasis on this year's official growth target, which is likely to be announced in early March. Most provinces, as you see it on the chart in front of you, especially the bigger ones, had already announced the 2024 growth targets, and most of them are between 5 and 6%. This is a good sign that the official growth target for the entire economy will be around 5%. The 5% target should be well received by the market because it implies more policy support, which is great, right? Well, let's see how much policy policy space China actually has and how much difference it can make for growth. Well, this is the list of most pro-growth policy initiatives announced by authorities since October last year. I intentionally formatted it in such a way that it fits on one page, even if you're most likely cannot see the details. But you can clearly tell that the list is long. And frankly, new measures are added up every month. Not all of them are quantitative with a price tag attached, but authorities are clearly talking up policy support. On the next slide, you can see that measures are mostly targeted. China decided against a wall of liquidity approach that was so popular in major developed markets during the pandemic. But as you can see on the left chart, even targeted measures tend to add up. China's fiscal expansion during the pandemic was normal and in line with policy responses in most advanced economies and EM peers. But while all emerging markets and many advanced economies unwound this stimulus afterwards, I would have to say that emerging markets did it much faster than DMs. China continued to spend as if there is no tomorrow. China's primary deficit stayed above 5% of GDP in the past 4 years, and now China is facing another major structural challenge in addition to dealing with the real estate bubble, local government debt. The chart on the right shows the extent of the problem. If you can back to previous slides, please. Local government debt is approaching 30% of GDP, and this is probably a conservative estimate. And this is not counting bonds issued by local governments. And more observers argue that the central government would probably have to assume at least some portion of this debt as part of the resolution process. Now, the move up the ladder is already happening. Provincial governments have been put in charge of the LGFE debt resolution. This is a big difference compared to the previous attempt to address the issue back in 2015, 2018. And the logic here is that provincial governments have more visibility and can mobilize more resources. Another important development is the return of special refinancing bonds, which is effectively a bond swap to replace debt related to local government financing vehicles with explicit debt of local governments. As you can see on the left chart, the size of this policy instrument is smaller than back in 2015, 2018, but this nevertheless helped to ease immediate concerns and lowered the financing costs for many LG fees. There are talks that the central bank might set up special vehicles to provide emergency support for struggling provinces. For example, during the COVID, the central bank and Ministry of Finance set up a special facility to purchase credit loans from commercial banks to SMEs, and banks had to repurchase these loans back in 1 year. Well, this is called cheap financing, effectively. However, given the extent of the problem, China's central government might need to get more involved at some point in the future. There are some big maturities in 25 and 26, and this means that China will still be running large fiscal deficits in the foreseeable future. The chart on the next slide should give you some idea just how large China's general government deficit could become. These are the IMF projections for cyclically adjusted primary general government deficits in China and the US. The US deficit problem is finally getting the attention it deserves after years of denial and dismissal. But just in 3 to 5 years, China's fiscal gap will be just as wide, right? How will China finance it? Who will be buying all this debt? Whether China's will be able to keep debt service costs low. I mean, we don't know. There are just way too many unanswered questions here, and the numbers are big. One saving grace, at least in the near term, you can see it on the next slide, is that some of China's currently existing support facilities are not fully used. You can see it on both charts in front of you. So for example, the central bank on average has used only 80% of its facilities at the end of 2023, and the outstanding balances are even low, if not to say non-existent in the property sector. And this tells us two things. First, China might have more room for maneuver in the near term, which will not impose more pressure on its fiscal metric. And second, in the case of China, the wall of liquidity probably is not the right approach. You can, so to say, lead a horse to water, but you cannot make them drink. You can create more and more facilities. Some commentators became very excited about president's supposed involvement and his ability to exert pressure. But if there is no demand or willingness to use these facilities, this is a signal that the problem is probably on the demand side and elsewhere. So on the next slide, one point I wanted to make clear is that addressing excessive leverage and market bubbles is the right thing to do. And this is frankly what responsible policymakers should be doing, and not just in China. The problem is that this is an uncharted territory, and it is clear that Chinese authorities probably moved too aggressively, especially against the backdrop of the pandemic and the lockdowns. And as a result, China's noble aspirations backfired big time. So the chart on the left shows that the volume of household mortgages remained at the decade's low in 2023. And the chart on the right shows the carnage in China's developers' bonds, which wiped out the 15-year gains. What is even more concerning is the situation in the housing sector. Well, the fact that it has not yet been fully resolved despite all these big market losses. So the chart on the left shows that even though the volume of sales and housing starts is down a lot, housing prices are actually holding on much better. And the chart on the right summarizes the situation with defaults in the sector in three simple numbers. The first default took place about 3 years ago, almost up to the date. There are now nearly 60 developers that defaulted on their bonds, but less than 10 completed comprehensive restructurings. This is not a lot. And this explains why households are not in a hurry to buy new real estate, why there is so much uncertainty about finishing the existing projects, and why banks are not in a hurry to use the existing support facilities. When we were preparing for this webinar, I was asked to talk about upside and downside growth risks in China. And I think that ultimately, the outlook is tied up to the resolution of developers' debt. And the table on the right summarizes both types of risks in the near term and also on the longer term horizon. And if the status quo persists, it's kind of hard to see any meaningful growth pickup. But if there is a restructuring process gains speed, China can easily overshoot the official growth target. When we talk about developers' debt restructuring, two names are mentioned more often than others. You can see it on the next slide, Sunac and Evergrande. The companies chose very different approaches, and depending on which one will become a blueprint for the entire sector, we can either move forward or continue to face the same uncertainties as we are facing right now. So what is the difference between the two approaches? In Sunac's debt restructuring, there were some losses and haircuts for offshore creditors, but not for most onshore creditors. There was no capital infusion from existing shareholders, but the controlling shareholder gave a shareholder loan, and the company also offered part of its assets to improve the recovery value for creditors. So this is not the most perfect solution. Nothing is perfect in this life, but it limited losses as well as moral hazard, and it also bought some time to deal with issues on the ground. These are the reasons why this is considered a better option and probably a preferred blueprint for the sector by many specialists. In the case of Evergrande, a court in Hong Kong ordered liquidation. Of course, it remains to be seen whether this verdict will be fully respected in mainland China. And of course, there are questions about onshore liquidation because the government probably wants the company to finish the unfinished projects. But perhaps there is a silver lining of sorts here, as such an outcome might encourage other companies to seek a faster, maybe Sunak-like debt restructuring. Now, while this is happening, one question that we are often asked, and we try to kind of represent this question on the next slide, is how about China's monetary policy, right? There were some moves in the past 10 days, larger than expected. In the past month, the central bank made several small cuts in the medium-term lending facility rate and also more aggressive cuts in the reserve requirements for banks, which were followed yesterday by the largest ever cut in the 5-year loan prime rate, which is a benchmark for mortgages. While this is not a game changer, I think this is a move in the right direction, and actually there are very good reasons why China's monetary easing should continue, even though China's nominal interest rates do not look particularly high. The reason is persistent deflation. This is our chart on the left. And this means that China's real interest rates are actually quite high. You can see it on the right chart. But China's monetary easing is a very delicate balancing act, and we try to show this delicate balancing act on the next slide, and the currency is at the very center of it. China's FX regime is slowly changing, with less intervention and allowing more volatility, but the currency stability as a concept is not dead yet. And one of the reasons is, of course, corporate external debt and potential implications for wider financial stability if the currency starts depreciating too fast. So it is not so much as fighting the underlying depreciation pressures, but trying to smooth the process as much as possible. And at least for now, China does have resources for this. What does it mean for China's monetary policy? Well, the chart in front of you shows that the renminbi does respond to the interest rate differentials with the US. And if the Fed stays on hold for longer, China is likely to proceed cautiously with rate cuts in order to reduce the pressure on the currency, especially if there are less capital inflows. And since I mentioned the US, I think this is a nice segue to the final slide of my presentation, geopolitical risks. Naturally, the US elections attract a lot of attention given the past history. And even though there is the bipartisan consensus regarding strategic competition with China, a prospect of President Trump's being re-elected is considered a major risk because it might be associated with another round of higher tariffs. The third T is Taiwan, and it is also moving closer to the front burner every year. So geopolitical tensions are here to stay, whether we like it or not. And we also keep an eye on the relations between China and another major regional power, and one of EM rising stars, India. So economic retaliations becoming a new normal is unfortunately a part of the current geopolitical landscape. But as chart on the right shows, alternatives can be eventually found, at least for some key commodities, but probably, we'll be talking about a different price range here. And finally, when we talk about geopolitics, not all developments are necessarily negative. China's geopolitical cloud and the internalization of the renminbi means there is more demand for the currency, especially from fellow emerging markets, even though, of course, this is a slow-moving process. The chart on the left shows the renminbi's progress in the SWIFT payment system, where it might be on the cusp of displacing the British pound from its position. So summing up, once again, I just wanted to quickly go through the main points. China's growth must slow. There are no quick fixes. The fiscal room is not unlimited. Property debt restructuring is key for the effectiveness of any additional stimulus, and FX considerations might dictate the pace of policy easing. And of course, geopolitical tensions are here to stay. Thank you for your attention.
Thank you so much, Natalia, for your insights and in-depth analysis. We've already got lots of people with a few follow-up questions, which we'll come to at the end. For now, we're on to our second speaker. We are now joined by Carlos Diez, who is the CEO and founder of MarketGrader, known as the world's smartest stock and ETF research platform. Along with the MarketGrader indexing team, Carlos is responsible for the methodology behind the China New Economy Index. He's written extensively on these new economy sectors, and today he is going to be taking us through the world's most unloved market. Carlos, welcome.
Thank you, Hannah. I think I wanted to make a bit of an impact with my slide, the world's most unloved market, and I think I'll start by showing a fact that actually caught my attention last week as I was doing some research for this presentation, which is depicted on the right-hand side of the slide. So Bank of America does a monthly survey of fund managers globally. So these are institutional managers. And in February, as one of the conclusions from the latest survey was that after being long the Magnificent Seven stocks in the US, which is something that everyone is familiar with, short China equities is the most crowded trade in the world, at least among institutional investors. So that caught my attention because that is very much central to the theme that I want to touch on today. But now let me talk a little bit about the three questions on our mind when it comes to China. So the first question is China's economy in secular decline? The second one is China's economy decoupling from the world's developed economies. I'll touch on this in reference to what I said last year at the China Symposium. And then, are you being compensated for the risk you're taking in Chinese stocks? So our thoughts or our views around these 3 points. The first one is no, China is not in secular decline. China is still getting rich, and it has a long way to go. It hasn't completed the cycle of becoming a developed economy, but its economy is transforming. It's a necessary transformation. Part of it is a deleveraging process, which is painful as we are seeing. The second one is that China is partially decoupling from developed economies around the world, mostly the European Union, the US, Japan to a lesser extent, which means that how you gain exposure to China matters. And again, I'll revert back to some of the views that I talked about last year. And then the third one is that Chinese equities are at peak pessimism, offering significant value. China has gone from years ago from being the world's best growth opportunity to being a value play, and that requires, in our view, a focus on company quality. So I'll start with the first point. China's economy is transforming, not in secular decline. And here, I always like to focus first and foremost on the consumer. So I think if you look at the chart on the screen, what's interesting about this is that you see a steady climb in per capita disposable income. I included the chart in Australian dollars for easy reference. And if no one told you so, you wouldn't think there had been a global pandemic by the looks of this chart. You see that the growth from 2019 to 2020 was not spectacular, but overall, steady climb up. Per capita disposable income grew by 27.5% from 2019 through the end of last year. So the consumer is in relatively good shape. However, consumer confidence is not. So this is a longer-term version of one of the charts that Natalia had in her presentation. We think that this is absolutely critical to what happens to China going forward, more specifically to Chinese equities. So we think that consumer confidence collapsed because of three unforced policy errors by the government. The draconian COVID lockdowns that lasted over 2 years was one of them. The fumbling of the real estate crisis, I have some thoughts on that. And then the ongoing attacks on the private sector, especially in the midst of the first two errors. So we think the first one has been corrected. Obviously, the lockdowns were ended, but the other two are still ongoing. So here's a look at retail sales between 2019 and 2023. So retail sales seem to be sort of growing nicely on trend, with the exception of 2019 to 2020, as you can see on the chart on the left-hand side. But I think what matters most is that the rate of growth, which is depicted on the right-hand side, is actually declining. So this is not necessarily a bad thing, especially because, and I've talked about this before, Chinese consumers are moving from owning things to owning experiences, or consuming experiences over things. So, that's going to be supportive of certain parts of the consumer economy, but it nevertheless bears watching in the context of what's going on right now. So Chinese consumers are not consuming. Where is all that money going? Well, that money is going into savings accounts. And China's households have always been prolific savers, more so in the last few years, given all the uncertainty in their country. So a staggering statistic that I came across last week is that since 2019, Chinese households have increased their savings by almost $8 trillion, which is equivalent to 83% of the value of China's A-share market today. That is incredible. Another way of looking at this is that since 2019, for every dollar that Chinese consumers spend in retail sales, they put $1.18 into savings accounts. So that tells you that there's a lot of firepower, consumer firepower at hand, that eventually might find itself into the stock market. We don't think it's as simplistic as that, but it's a statistic that bears watching. So the conclusion of all this is that although it's a challenging environment for the Chinese consumer, consumer confidence is the biggest issue. Nevertheless, the chart on the right shows that the economy is indeed transforming. The contribution share to GDP by final consumption expenditure now accounts for almost 83% versus 59% back in 2019, whereas gross capital formation has basically plateaued at a little bit under 30%. So in our view, further progress on this transformation is going to depend significantly on government policy. And for us, the two bigger questions are, number one, can it provide a believable solution to the real estate crisis? Emphasis on believable, because nothing that they've done so far has been essentially has done the trick. And the second one is, in our view, will it provide regulatory clarity and support for the role of the private sector in the economy? One day they come out and say that they support the private sector, that the private sector needs to lead job creation, economic growth, and so forth. And then the next day they come out and penalize some other part of the private economy. So those two are the two bigger drivers of policy that we are looking at. So our second view is around decoupling, which was kind of the core of my remarks last year. So I thought it'd be fair to maybe bring up an exact slide from last year's symposium. And basically, the point that I've made is that the economic relation between China and the rest of the world has been changing structurally since before the pandemic. I would also argue that it has been changing structurally since before Trump became president. I think there's a policy, and I think a better way of looking at decoupling is what I call a policy reducing economic dependencies, which is being pursued by both sides. Some of it is geopolitical, but a lot of it is just pure economic interest. So because I brought up my remarks from last year, I think it's fair to do an assessment of how we did relative to what we prescribed as being some of the main themes from last year. So, not the first point we made is focus on the consumer. Consumption will surprise to the upside in the second half of 2023 once consumer confidence recovers. That was a miss. That was a miss because consumer confidence has not recovered, and although consumers are spending, like I showed before, the rate of growth in consumer expenditures has declined. The second point, focus on the gradual transition from foreign to indigenous brands. That is still happening. It's pretty clear that Chinese are more and more preferring domestic, local national brands to foreign brands that they used to prefer in the past. So that has been a hit. The third one, government stimulus will be directed to supporting households. And here we meant it in the context of real estate projects. That has not been the case. I think the jury is still out. It's still very uncertain as to what they're going to do to support a lot of home buyers that are yet to be made whole. So we'll call that a miss. Then we talked about a massive gap in healthcare spending in China. Not much has been said about this. I'll call that uncertain, and it's really not one of the main topics for today. And then the last two are interrelated. We've been talking about the government subsidizing and supporting some technologies or some industries it considers critical to its development: semiconductors, EVs, clean energy, and eliminating dependency on foreign technology. So those two have been a hit because that has very much been the case in the last year or since we last spoke. So going back to the decoupling point, I think the decoupling is something that's going to be a significant issue for a long time. I think Natalia touched on this, and I think the consequences of decoupling are barely starting to be seen. I think it's going to take some time before we see the actual true consequences of the separation or this decoupling or partial decoupling of China and some parts of the rest of the world. So I think a lot of it has to do with decisions being made by the private sector, especially foreign entities operating in China or doing business with China. So in this case, I looked at a survey from the U.S.-China Business Council. This is from the end of last year, and you see some of the decisions that businesses are making in light of what we call this ongoing decoupling. So how have their business been affected? Over half of them said that they've lost sales due to customer supply chain uncertainty. More than 1/3 are delaying or canceling investment in China. Also, more than 1/3 are shifting suppliers or sourcing due to uncertainty of supply. So you don't shift your supply chain overnight from China to India or Vietnam or other places, or Mexico in the case of the United States. But you do it over extended periods of time. Once you take that out of China, it's very difficult for it to come back. So the consequences of this are going to be felt for a long time. And then another part of the survey actually asked companies how they've altered their strategies to kind of account for the tensions between, in this case, the U.S. and China. And again, 1/3 said they're developing new supply chains for China-specific, U.S.-specific, or other region-specific. So people, companies are building their supply chains closer to where their customers are. So obviously that's going to have significant impacts for China's economy, but also for the economies of the rest of the world. So again, decoupling continues, and it's only going to accelerate as some of the consequences of these decisions are felt over time. Then going back to one of the themes that I talked about last year, China is super focused on lessening their dependence in specific or critical technologies from the rest of the world, and somewhat quietly they are achieving their goal. This chart shows that right now China has just about, or is projected to have, close to the same capacity for semiconductor fabrication as does Taiwan. Granted, not the same type of semiconductors, but we believe that China is going to be a significant source of semiconductor manufacturing in the future. A lot of it is going to be used internally or domestically by their own industries, their own companies. So this is still very much underway. A couple other points worth mentioning about their ongoing support for some key industries, production of electric vehicle by 2027. China is going to be almost half of the world's EV production. And then the chart on the right shows how far ahead they are of the rest of the world in terms of industrial robot installation. So again, all of these trends are going to have very significant consequences for investors, both in Chinese companies and for investors outside of China. So, and then the last point that we like to raise today has to do with what we call peak pessimism. So it looks like that things can't get any worse for Chinese equity investors, or so we hope. Obviously, we are in the throes of a brutal bear market that has lasted for about, a little bit under 3 years. But we think that China has gone from being, like I said before, the world's best opportunity to a significant value play that requires a rule book around quality companies, or the quality of the companies that you own. So just a couple of charts to show the peak pessimism that I'm talking about. This is a chart that going back to 2014, so 10 years, shows the net flows into Chinese stocks through Hong Kong Stock Connect, which is how most international investors access the Chinese equity market. And then you see that between the end of last year and this year, the net has basically been negative. So the flows have collapsed, or in other words, it's basically a rush for the doors or for the exit. So, but we look at it a little bit differently. So a lot of you might know MarketGrader, know how MarketGrader selects companies. Ours is a fundamentals focused approach. We cover about 41,000 companies globally through this GAR plus quality approach. We're a very fundamentally driven investment firm. And that's, the rating that comes out of the score and the rating that comes out of this analysis is what we use to select companies to the China New Economy and to all the other indexes that we build around the world. However, we also track, or we also compute every day what we call a sentiment rating for all companies that we cover. And this gives us, I think, unique insight into how investors are feeling broadly about different markets around the world. So very quickly, what does that mean? Our sentiment rating, again, we calculate it for every stock, uses 4 indicators that are recalculated every single day. 3 are sort of technical in nature. The first 3 that you see on the left-hand side. Another one, earnings guidance, is measuring how analysts covering any company around the world are reacting to news around the company. And so we summarize those 4 indicators into one final score between 0 and 10. And obviously, the higher the value, the higher the sentiment, and the lower the more negative the sentiment. So in our view, we like to see this as an early warning system, because it shows when a lot of the story is baked into the price of the stock, positive or negative. So it tends to be a pretty good contrarian indicator. So, and because we do this for so many companies, it makes a lot of sense to aggregate data on a country-by-country basis, which is what we do for the US, we do it for China, we do it for a lot of markets around the world. So, and we have found over the years that calculating a ratio of positive sentiment stocks to negative sentiment stocks in any given market gives you an overall sense for how investors are feeling about that market. So an example that I have on the screen is the sentiment index for the S&P 500 as of this week. So right now, the S&P 500 has 268 positive sentiment scores based on our rating, based on our system, and 64 negative sentiment stocks. So that's 4.2 positive sentiment stocks for every stock with negative sentiment. So that's you see the gauge we have on the left-hand side. That's what we call extreme optimism, meaning it's time to be a little bit concerned, or at least a little bit mindful of what you own or at what valuations you're buying. So what is that index telling us about China right now? Before we get into China today, I think it's worthwhile looking at what that sentiment index did back in 2015 and then the drawdown after that. So for those of you that remember, China had a massive, massive rally in equities in 2015. As you can see, in the span of less than a year, the CSI 300 climbed by almost 150%. Our sentiment index rose all the way to 2.44. That means almost 2.5 positive stocks for every negative stock. And then it immediately crashed to the ground. And then the sentiment index bottomed out at 0.01. Essentially, there were almost no stocks with positive sentiment in China at the bottom, which was around February of 2016. From that bottom, the market went on to gain 9% through its peak in 2021. If you look at a comparable chart for the A plus H market, and actually the chart on the right should be showing the title should be showing MSCI China. So MSCI China tracks both domestic, onshore and H listed or Hong Kong listed securities. Comparable chart. The run up was not as massive, still 60% in less than a year. Our sentiment index peaked at a lower level, 1.5 or 1.53, and then it bottomed at a comparable number, 0.01, and then from then on it went on to rise by 144% from trough to peak. So what is it doing right now? So right now the sentiment index has clearly tracked what equities have done. So right now, for the onshore market, tracking the CSI 300, the sentiment index is 0.49, which means less than half a company with positive sentiment for every company with negative sentiment. And then for the Hong Kong plus A market is a very similar number. So the numbers are very close to the bottoming of the sentiment index back in 2016 that I alluded to before. And then to put this into context, I wanted to share the sentiment index for some indexes from around the world that can give you an idea for where some of these exposures are in terms of sentiment, like we track it. So among the ones that I picked, the most bullish one, where we see the most extreme optimism, is the Russell 1000 Growth Index. That's heavily tilted towards the Magnificent Seven and large cap and mega cap tech stocks in the United States. The Fidelity Crypto ETF. There's been a bit of a cryptomania here in the US the last few weeks with the approval of spot Bitcoin ETFs. Is at 5, S&P 500, like I mentioned before, 4.2, MSCI Japan 3.5. Japan has been one of the stellar performers the last couple of years. Nasdaq 100, elevated but not outrageous, and then you see some of the less or more unloved exposures around the world. Russell 2000, so essentially U.S. small caps 1.4, MSCI Emerging Markets 1.1, and then at the very bottom, CSI 300 and MSCI China. So the point that we are trying to make with this, or that I'm trying to make with this, is that it doesn't get much worse than this in terms of sentiment around a specific equity market from an aggregate perspective. So having said all that, we bring it all back to what really matters to MarketGrader. We are fundamentally oriented investors. So I think for us, what matters most is how much are you getting for your dollar of investment today, and especially at current valuations based on companies that we own or that we have selected to the China New Economy Index. So one of the points that we are really focused on, or one of the metrics that we're really focused on, is growth is always important, but we're really focused on margin sustainability. So we think quality is going to be important. We think that with a lot of the uncertainty in China, especially around the private sector, especially around government policy that is still very much unknown, it's really important to focus on quality. For us, margin expansion or margins expansion or sustainability is a good way to make sure that you're following high quality companies. So the chart on the screen shows the aggregate net income to revenue for all the companies in the MarketGrader China New Economy Index in 2019 and today. So side by side with the CSI 300. So the CSI 300 aggregate margin, so to speak, has shrunk a little bit from 9.9 to 9.3. The margins of the constituents of the New Economy Index have actually expanded by 300 basis points from 16.8 to 19.8%. So that is very healthy in our view. A phenomenon that I think is incredible that we did not expect to see is how much of these companies, and this is across the board in China, are focused on return of capital to shareholders through much higher dividends than they paid before and share buybacks. Here, I'd like to focus on the dividend portion of that return of capital to shareholders. This number that I have on the screen, where the blue bars are, is incredible to me because a lot of the China New Economy Index constituents are higher growth companies, like I showed before, younger companies. So you expect to see more growth and a lot less focus on income generation. Yet, in the aggregate, they have increased their dividend payments a fourfold between 2019 and 2023. So in our view, what these companies are saying is the market is not rewarding our financial results, so we're going to reward our shareholders by returning capital to them. I think that's incredibly important because in a way, it gives you a bit of a margin of safety in owning these companies that might not exist in other parts of the market. On the right-hand side, you see that CSI 300 index companies, which are much larger companies, a lot more SOEs, a lot of old economy stocks that are sought after mostly for income, have also increased their payouts, but only by 53%. From 2019 to 2023. So amazingly, when you aggregate all the dividends relative to net income, today, on a relative basis, the new economy stocks pay more of their net income out as dividends to shareholders. Again, that is the margin of safety that I was alluding to. And then lastly, but very importantly, valuation in the context of growth, right? So next year, the companies in the New Economy Index are expected to earn 24% more in earnings per share than they did a year ago. And you're paying right now 14.8 times those future earnings, as you can see on the right. Yes, you're paying less for the CSI 300, which is at 9.3 times forward earnings. But then again, those companies have not grown and aren't expected to grow as much as the MarketGrader New Economy. So conclusions, kind of like to bring it home, to emphasize the points that I made throughout the presentation. China's economy is definitely not in secular decline. We do think that the ongoing growth trajectory has been interrupted by government policies or mistakes. Very uncertain as to what's going to happen there. Point number two, we have no visibility about the direction of the stock market in the short term, but it is very hard to envision a situation where it gets much worse. Again, peak pessimism is pretty clear, at least in the numbers that we're seeing. But again, the big wild card is economic policy. And lastly, high quality Chinese stocks are very attractive at current valuations. So that kind of wraps it up for me, Hannah. Thank you.
Thank you so much, Carlos. That was really fantastic. There was a lot of insights on the more under the radar changes and transformations happening in China on valuations, and I guess really reiterating how important selectivity is at the moment. Thank you, Carlos. On to our final speaker for today. I'm pleased to introduce Alice Shen. Alice is a portfolio manager in our investments team here at VanEck. Alice's area of expertise is in Chinese equities, ESG, and stewardship in particular. Alice has previously worked at State Street, as well as RBC Investor and Treasury Services, as well as the Bank of China International. I'm delighted to welcome you, Alice, who's going to delve into, Carlos touched on healthcare very briefly, so Alice is going to delve into that China New Economy sector and talk through the strategies and considerations to keep in mind when investing in Chinese equities. Thank you, Alice.
Thank you, Hannah. Thank you, everyone, for tuning in today. I think that I think some of the audiences that tuned in last year may remember that we talked extensively about China's new economy sectors, in particular consumer sector and also IT. But another sector that I would like to draw your attention on today is the healthcare sector in China. It probably hasn't received much spotlight in media, but we think that it will have potential to grow further. And then I would like to move on to going through the nitty-gritty of overall Chinese equities in general and how Australian investors can access China. Okay, so from our perspective, we think that the Chinese healthcare sector will continue to grow simply because, as you can see in this graph here, the healthcare expenditure in the Chinese economy as a percentage of GDP is still much less than developed markets such as Australia and United States here. To put it into context, the Chinese healthcare system in general is similar to Australia in the sense that it has both private and also public provision. And it serves over 1.4 billion people. Historically, the system has had quite a few reforms to transition from a largely state-owned model to more private involvement and more market mechanisms into this sector. And over the last decade, one of the reform priorities is to strengthen the public health systems, especially during the pandemic era. The public health system was pretty much collapsed, and there must be some more investments into the healthcare sector in general. From the top policymakers, the country's Healthy China 2030 initiative is a breakthrough to basically ensure that the Chinese population have access to health. The plan puts forward 5 strategies, including popularizing healthy lifestyle and also optimizing the health service and also developing the country's health sector broadly. The other point I'd like to make is that based on the analysis done by the World Health Organization, at the start of the century, less than a third of the Chinese population had access to health insurance, whereas now almost 100% do. So there has been some progress made over the years. And if we look at past 10 years, the total health expenditure increased from just over 1,000 renminbi per capita in 2008 to over 4,700 renminbi in 2019, an increase of over 330%. So as we look into the future, China still faces quite a bit of health challenges. This includes the increasing rates of cancer and also cardiovascular diseases linked to lifestyle choices such as smoking, and also undeniably an aging population. So a key component of this Healthy China 2030 initiative is to encourage a more healthy lifestyle and fitness, physical fitness, instead of putting a lot of pressure on public hospitals. As China improves the social safety net and its capital markets, the healthcare sector is expected to grow quite strongly. And we think that the overall expenditure into the healthcare sector will continue to grow as well. Now, let me take you through the Chinese pharma sector in particular within the healthcare sector. I think it's been growing quietly in the background, but probably hasn't received much attention. And this analysis I've done is to highlight the structural growth in the Chinese pharma sector. As you may know, for the pharmaceutical industry, licensing is a very important aspect of the business strategy. Licensing agreements in particular can allow companies to gain access to new products or technologies or intellectual property, if you like. There are 2 main types of licensing agreements. The first one being in-licensing. In-licensing simply means taking in. It's a process where a company A or the licensee acquires the right to a product or technology from company B or the licensor. This can include the rights to basically develop or manufacture a particular pharmaceutical product. In-licensing allows the licensee, in this case, to expand its product portfolio or access innovative technologies without having to develop this technology or product in-house from scratch. The other type of licensing agreement is out-licensing. So out-licensing is the other way around, pretty much, is when a company A or the licensor grants the licensee the right to use its product. Out-licensing allows the licensor to generate revenue from its assets or capitalize on the licensee's expertise. Over the past few years, we've seen the total number of out-licensing deals for Chinese pharma companies increase, as shown on the left-hand side here in the slide in light blue color. Also, on the right-hand side, we have the total value of the deals over the past few years. As you can see, the total value of the out-licensing deals for Chinese pharma soared to over $28 billion in 2022. This rise of out-licensing deals reflects the fact that China's pharma technology and innovation has been receiving increasing recognition overseas. And in general, R&D is still cheaper to do in China. To give you an example, last year in 2023, one of the high-profile deals that involves a Chinese company called Ecogen and also AstraZeneca. The deal pretty much involved Ecogen granting development and commercialization rights of potential treatments, including obesity and type 2 diabetes. According to the terms of the agreement, the Chinese pharma company will receive an upfront payment of $185 million and also up to $1.825 billion in future clinical registration and commercialization milestone payments, and also tiered royalties on net sales. So overall, there are some structural highlights in Chinese pharma companies. We've talked about the broad healthcare sector so far and also some highlights from the pharma industry. But I'd also like to draw your attention to the investment side. Currently, the onshore healthcare stocks are looking very attractive to us in terms of valuation. As you can see, it is trading below one standard deviation above the 5-year average at the moment, with a forward PE of just 19.1 times. So to us, this could be a potential entry point if you are looking to invest in China in the Year of Dragon. Next, I have two stocks that I would like to take you through today. The first one is called China Resources, Senzhou Medical and Pharma. Senzhou here is, it means 999 in Chinese. I actually grew up with this brand because it is a quite common Chinese medicine brand for treating cold. This particular brand is supported by its unique 1+N branding strategy. In other words, there are multiple subsidiary brands under this 999 umbrella brand. The company has had quite robust growth so far, and it has very decent market shares in the over-the-counter products and also Chinese traditional medicine formula granules, where the company holds 1 out of 6 national licenses granted by the government. The company's revenue has been quite solid as well from its core over-the-counter business, and it grew 11% on an annual basis from 2012 to 2022. Given its leadership in this particular sector and strong brand recognition, Shenzhou could still continue to outperform from its competitors with stable earnings and ongoing expansion of its product portfolio. The next stock is called Shenzhen Mindray Biomedical Electronics that specializes in medical equipment and supplies. Over the years, Mindray has become China's top and also world's leading medical devices and solutions. The company is headquartered in Shenzhen, which is China's innovation hub, and 24% of the employees of Mindray works in the research and development. Mindray has over 50 overseas subsidiaries in almost 40 countries across the continent, and 40% of the sales is generated from overseas. Mindray owns the top market share at the moment at around 27% and is set to benefit from the hospital capex recovery and also domestic substitution trend. The company is expecting higher growth rates in 2024 from emerging markets at around 25%. And also in developed markets, they are also expecting a record high growth of 15% for 2024. Now, let me take a step back and provide a bit of overview of China's stock market in general. As Carlos briefly mentioned earlier, Chinese equities had one of the most turbulent years last year. However, it still remains the second largest stock market by market cap, just after US Nasdaq exchange as well as New York Stock Exchange. In mainland China, it has two main stock exchanges. One is Shanghai Stock Exchange, and the other one is Shenzhen Stock Exchange. On the right-hand side as well, from the index point of view, MSCI has at the moment roughly 28% allocation to China. While this is quite significant, China A-shares in particular, which are the stocks that trade in mainland China only, accounts for only 4.3% due to the inclusion factor being capped at 20% at the moment. If it were to be fully included into the index, as China continues to open up its capital market, then the A-share allocation would rise to around 19%. It's estimated that the foreign inflows could be up to 400 billion over the next decade. So to us, China is still a big opportunity, and to us, it is an opportunity that is too big to ignore. Here I have a correlation matrix of two China Asia indices. One is the China New Economy Index and also FTSE China A50. And on the other side, I have the S&P 500, ASX 200, and also MSCI World X Australia as the benchmarks for developed markets. As you can see, China A-shares have shown very low correlation with developed markets, which could provide a bit of diversification in investors' portfolios in times of volatility. And if we look at fundamentals as well, valuations in China onshore market is looking very, very cheap and attractive. For instance, the FTSE China A50 index, which consists of the top 50 and most liquid China A shares, is trading at over 30%, close to 40% discount compared to developed market indices on a forward PE basis. Before before one invests in China, I think there are quite a bit of intricacies to understand. The first being the types of Chinese stocks you are getting. An easy way to tell one from another is by looking at the country of incorporation of a particular stock and also its country of listing. Let me kick off with the A-shares. A-shares is the largest category among all Chinese equity universe, and it currently has over 5,000 stocks in this category. These stocks are both incorporated and also listed in mainland China. Foreign investors can only access China A-shares via a QF license or an RQF license, which I will go through a bit more in the next slide. Some, but not all A-shares can be traded via Hong Kong's stock exchange program. The next type of shares is B shares. These companies are still listed and incorporated in China. However, they are traded in different currencies, such as US dollars or Hong Kong dollars. Moving on, we have H shares. H shares is the second most common type of Chinese stocks. They are incorporated in mainland China, but they are listed in Hong Kong Stock Exchange, and they trade in Hong Kong dollars as well. Now, the next we have R-chips. R-chips are essentially state-controlled entities. They are incorporated outside of China, but they list on Hong Kong Stock Exchange. The next type is P-chips. P-chips is exactly the same as red chips, apart from the fact that they are privately controlled instead of state-controlled. And last but not least, we have N shares. These are the companies that's incorporated outside of China, but they trade on New York Stock Exchange or NASDAQ in the US. The main takeaway of this slide is that since A shares make up the largest part of the Chinese stock universe, investors should have a reasonable allocation to A shares if they'd like to have a direct exposure to China. Now, speaking of exposure, gaining access to China is not really straightforward as, say, buying US stocks or European stocks. There are regulations around who can actually buy it from the foreign investor perspective. Only qualified foreign investors can gain the full suite of access to mainland Asia. At VanEck, we own the RQF license, which is short for Renminbi Qualified Foreign Institutional Investor, which allows us to invest in China and invest in Chinese mainland stocks without restriction using offshore renminbi. Only select investment managers around the world are granted this license to trade mainland Asia. Because of these rules in place, some funds may claim that they give you exposure to China, but not really. They are actually giving you exposure of Chinese companies that's listed outside of China. Investors in those funds may be at risk of less diversification. For instance, H shares, they are pretty much dominated by financials. And also, if we look at combined P shares and red chips in the communication sector, it's actually just one massive tech company, Tencent. In other words, those companies that's listed offshore may not provide you the access to the full opportunity set of China, which we would argue is only available in mainland China. Now, we've gone through quite a lot of opportunities when it comes to investing in China, and VanEck has decades of years of experience in investing in China and has been at the forefront of ETF innovation. Let me take you through a couple of our China-focused offerings. The first one is our VanEck FTSE China A50 index with the ASX ticker CETF. It tracks FTSE China A50 index, which is a basket of top market cap and most liquid China A shares. And the next one we have is our flagship China Asia ETF, VanEck China New Economy ETF with the ASX ticker CNEW. We partner with MarketGrader for this fund, and it was launched back in 2018 as our first China Asia Smart Beta ETF listed on ASX. The strategy is equally weighted across 4 new economy sectors, including consumer staples, consumer discretionary, IT, and healthcare. These constituents trades in mainland China and have the best growth at reasonable price attributes, which are considered the best drivers for long-term capital appreciation. The companies are assessed based on a couple of factors, including growth, value, profitability, as well as cash flow. Lastly, if you'd like to take a more diversified approach when it comes to investing in emerging markets, not just in China, then we also have the VanEck MSCI Multi-Factor Emerging Markets ETF. The unique feature of this one is that it utilizes a screening process with the factors involving value, low size, momentum, and quality. Last but not least, if there is one thing that you can take away from my segment today, feel free to go through a checklist with me with all things China. The first one is that using ETFs when it comes to investing in China have quite a few advantages in that it is fully transparent. The daily holdings of the portfolio are published online every day for your reference. And also, with a single trade on ASX, you could access a basket of China A shares and cost effective. Lastly, the live ticking pricing intraday is useful for price discovery. And when it comes to the tips to invest in China, make sure that you check your exposure to China is true to label. Are the companies that you invest in listed in China, or are they listed offshore? Because China A shares have deeper liquidity in general and has the largest market cap among all the categories that we've just gone through. And also have a check of the experience and qualifications of your investment manager is also important. A quick mention in terms of trading execution, if you decide to use ETFs as well, it's best to trade China when both ASX and the local stock exchanges in Shanghai and Shenzhen are both open. At this time of the year, China is open from 12:30 p.m. Sydney time. And last but not least, always check that the fund manager's management fee is commensurate with the performance. So as with all investments, be sure that you are aware of any investments, any risks before you invest. That's all from me. I'll hand it back to Hannah now. Thank you.
Thank you so much, Alice. That was fantastic. We'll get straight into our questions for today. All right, and thank you to everyone who's sent them through so far. All right, so we'll start with one for Natalia. Natalia, we've got you there, don't we? Perfect. We've got, what is the level of China offshore US reserves, US dollar reserves?
Well, China is unique in many respects, and one of these unique aspects is that China, as far as I know, is the only country which is hiding its international reserves. I mean, this is probably the only country in my experience in emerging markets which doing it for various reasons, transparency, lending to other countries. But the name you need to know if you want to kind of get educated about these China's hidden reserves is Brad Setzer. So he did a very interesting study, and his estimate is that China's so-called hidden reserves are about $3 trillion US, which effectively doubles the size of official reserves. So what China is doing, I mean, how China is hiding these reserves is by selling or loaning them to kind of another part of the government. For example, China's investment corporations, state commercial banks, policy banks, with the PBOC getting renminbi as collateral. So the number you need to know is 3 trillion, and the name you need to know is Brad Setzer because he did a lot of research in this area.
Thank you, Natalia. All right, we've got one for Alice, and I think, so Natalia and Carlos talked a bit about consumer confidence, and we've essentially just got what would boost consumer confidence. And I think that also ties into a few other questions we've got about what would make Chinese consumers stop saving, start spending or investing.
Yeah, thanks, Hannah. This is a tricky question because at the moment it's hard to encourage consumers to get spending again. However, we did see some very positive stats coming through for the past Lunar New Year. People are traveling, people are spending. But overall, I think the most crucial elements is that because there's a huge participation rate from retail investors in Chinese equity market, I think the stabilization of the equity market is very important for Chinese households. And also a more coordinated effort from the top policymakers is also very important for consumers to revive the confidence and then start spending again. I think in the market, there are a few chats about the consumption coupons, basically handing out the cash for consumers to use to start spending again. So far, we haven't seen any evidence that this is a possible solution, but I think that this can be an important and effective tool to boost and repair the confidence from the consumption point of view.
Thank you, Alice. And might elaborate on that with Carlos. I'd be keen to get, Carlos, your perspective on this question, which sort of a longer version. We've got, what is the most important policy reform yet to be tackled to restore confidence and shift transitions from real estate savings into financial markets investment?
I think by far the biggest issue that the government needs to tackle is the real estate prices. By far, I think that's going to solve a lot of the problems, not immediately, but a lot of the problems. And I think if I were the Chinese government, I would look at 3 points that I would make with some kind of resolution. The first one, it has to be super clear as to what it is that they're doing, and it hasn't been so far. Number two, it needs to be large, very large. And then number three, it should involve the private sector. And I'm not holding too many, my hopes up on that. But there is actually a model for what they could do, somewhat of a model, which is, in my view, based on what happened in the U.S. with the savings and loan crisis in the 1980s. So at one point, savings and loans are financial institutions in the United States that were designed to support home ownership in the United States. And at one point, they grew so large that they accounted for about half the mortgages in the country in the early 1980s. And they ended up holding a lot of really bad assets, non-performing assets. The government in the early 80s tried to, apply a lot of minor solutions. Nothing worked until in the late 80s or early 90s, they created this entity called the Resolution Trust Corporation that basically allowed this entity to use the borrowing power of the government to acquire these thrifts and basically unwind them with support from the private sector. And that's essentially what they did. At the end of the crisis, the entity, and I gather some numbers today because I think there's an incredible parallel for the Chinese economy. At the end of when RTC was unwound, they had helped close 747 thrifts or savings and loans institutions in the United States, or 1/4 of the industry, and they were responsible for selling with large participation from the private sector $450 billion in 1990s dollars of real estate. So if the Chinese consumers saw something forceful like that, where essentially the government says, we are the buyer of last resort, we're going to buy, in this case, not savings and loans type institutions, but real estate developers that are non-performing, we're going to take that, not nationalize and socialize, and we're going to partner with the private sector to dispose of the assets in an orderly way. It's not going to happen quickly. With the borrowing power of the government, I think that's sort of the sort of solution that they need to apply. But the consumer doesn't need to wait for the entire thing to be resolved. The consumer confidence will recover very quickly, very soon, if there's clarity that this is what the government is going to do and the program is large enough to do so. That's my take on what they need to do. But I think that by far solving the real estate issue is the #1 thing they need to tackle.
Thank you, Carlos. That was really interesting. Natalia, I might shift back to you. We've got, what is China's level of exports compared to 2018? So I guess how it's changed over the last few years.
Yes, so the numbers are around 3.4 trillion in 2023 versus about 2.5 trillion in 2018. But I would encourage you to look at these numbers as a share of world exports, because they can actually give you a much better picture as to what happens. And the numbers are about 14.4% of world exports in 2018 versus around 13.7% last year. So China's exports as a share of global exports peaked at around 17% in 2020. So there is a decline. But I think, I wouldn't look just at exports, because I think there was another very interesting thing happening on the trade balance side, trade surplus side. Specifically, China's trade surplus with developed markets is still declining. It peaked, I think, if I'm not mistaken, in October 2022, but China is now running a trade surplus with emerging markets. So I think that's a new development. COVID pandemic definitely kind of spearheaded that development, but that's a big change and a big shift.
Thanks, Natalia. All right, we've got one sort of directed to all of you. I might get Alice to answer first. There seems to always be endless headlines, negative headlines concerning China. Keen to hear the panelists' thoughts on how accurate Western media's reporting on China is in their opinion. Alice, do you have some thoughts on that one?
I guess it's half true. But last year I traveled back to China, and every single time I travel back to China, I always find something new from those, say, the massive adoption of EVs on the road, and also those mega all-in-one apps that includes everything you need in life, including like car hailing or payments or utility bills, everything you need. So there's some development happening in China which Western media probably haven't captured. But I think that China is still developing and growing. But understand there might be some ideological differences between how Chinese economy is doing and how Western economies are thinking of China. So it is half and half, I guess.
That makes sense. Thanks, Alice. We have run out of time, but I really like to end today answering the question that we posed in the title of today's webinar. and get your three opinion on, based on everything we've discussed, would you invest in China? And maybe Alice, while we're on to you, if you want to start on that one.
Just my personal view, I am still positive that China will continue to grow in certain areas.
Yeah. Natalia, what are your thoughts?
I think there is definitely space to invest in China right now. For example, you can, even if you have concerns about strategic and long-term exposure to China, you can definitely ride these policy waves, because on a short-term basis, that could be very, very interesting. And again, we are like, I can think about very curated exposure to certain names, even in real estate, because some of the bonds are trading like cents on the dollar. But again, it should be very curated, very specific, and very targeted.
Thanks, Natalia. And Carlos, to finish off today, any final thoughts on that?
Unequivocally, yes. A lot of it has to do with my personal investment temperament. I like to be a contrarian, so I like to invest in the most hated stuff. If you know what you're investing in, we like to think that the companies that we own in the new economy index are the best companies in China. So yes, it's just too big a market to ignore, and the opportunity. I have no idea what's going to happen this year, maybe not next, but the opportunity long term is there. It's just it's going to be the largest consumer market in the world, and nothing's going to change that. So absolutely, yes.
Thanks, Carlos. Thank you, all three of you, for joining us. I think I, for one, have learned a lot, and I hope everyone else who joined did as well. Thanks to everyone who tuned in. We hope you got a lot out of today. Once you do leave the webinar, you will be directed to a very brief survey where you can leave us some feedback or ask any final questions. Thanks again to our panelists, our audience, and we hope to see you in our next webinar. If you want to keep up to date with when that will be, a great way is to follow us on LinkedIn. I can pop the link in the chat so you can do so, but otherwise we'll see you in our next webinar. Thank you all.